Uh, Here is a specific session because President also requested that we should have a role which cost accountants play, especially with reference to IFRS. And we have this cost accounting standards, CAS 1 to 15. And thanks to Veer Raghavan sir, who had been a very great inspiration for me. We are talking about, along with Purna, expert from India but exported to Sweden, and talking about cost accounting standards and how a cost accountants will have to link up CAS vis-a-vis IFRS. So Purna, can we go standard by standard quickly so that our costing friends get a link where they need to have IFRS inputs?
Yeah. First, talking about classification of cost, how does it help?
Yeah, regarding the CAS 1, the classification of cost, one needs to understand that IFRS allows two types of preparation of profit and loss accounts. One is function wise and another is nature wise. And function wise is similar to what we call it in our costing papers as department wise. And this classification of cost, when one does, the typical thrust is on substance. So for example, if a depreciation of a factory building is in the nature of, it is in the nature of cost of sales, whereas the office building depreciation or impairment is in the nature of what you call it as a administrative cost. So function wise P&L is something which cost accountants, while making the classification of cost, will have to have input sufficiently for of IFRS.
The second CAS is about capacity determination.
Right.
And how does it help in inventory valuation?
Yeah. You know, this capacity determination, we all know that capacity is a very challenging area because capacity is somewhat flexible always and engineers understand it more. But the cost accountant, thanks to the CMA Institute for keeping the engineering people where they are the best judges for having the cost and management accountancy a little bit supremacy over others because they have a good factory exposure and the engineering exposure. Arising out of that, if they know and do a very well drafting of the capacity utilization by using the CAS standards, they will need to have an inventory valuation done in a proper way because the IAS 2 and Ind AS 2, which is on inventory valuation, needs a proper allocation of the fixed overheads. On the under capacity utilization, capacity underutilization or capacity overutilization, and the treatment of the two is different when you calculate the cost of the inventory. So that's where the CAS 2 and IAS 2, luckily both the numbers are 2, perhaps it's a great coincidence that inventory standard and the capacity utilization standard has a lot of linkage.
Coming to CAS 3, it talks about overhead allocation, absorption costing. How does it help?
Right. Now, in terms of absorption costing, we all know that we all study what is known as operating segments, or in Indian standard, we had what is known as segment reporting. And the segment reporting now has to be taken from the internal MIS. Now, the question comes that whichever segment is more than 10% of the total, say, revenue or say profit or say assets. Now, when we come to calculate the operating segments which are above 10%, the profit which is calculated for each of the operating segment in the MIS requires a overhead allocation. And actually, the operating segments talk about stopping at the operating profit level. So therefore, especially the allocation of overheads, particularly the direct overheads, even if perhaps they are marketing overheads, need to be considered. So CAS 3 per se, overhead allocation has a lot to do with operating segments. And I mean, I would say we are all accountants, cost accountants, chartered accountants, company secretaries, focusing on the balance sheet very closely. And when the external world is going to see into the operating segments reports, the CAS 3 preparing people, they will be definitely questioned for and will hold a higher responsibility as to in the operating segments calculations of profits, how the cost accountant has played a role and arrived at a right overhead allocation.
We can also talk about CAS 4 that talks about capital consumption.
Yeah, that's right. I think thanks Purna for I was missing that out. You know, the operating segments, the above 10% quantitative criteria are applied with internal as well as external turnover. So the CAS 4, particularly captive consumption, is treated as an internal revenue, and the operating segment crossing 10% of revenue, that time the revenue is considered as internal plus external revenue. So on one hand, some records have been kept for CAS 4 giving captive consumptions, and on the other hand, the internal revenue considered for the purposes of calculating the operating segment MIS, they will have to match or they will have to get justified in line with IFRS and Ind AS. Here I refer to IFRS 8 and CAS 4.
Okay. Coming to CAS 6, it talks about material cost.
Yeah.
So
again,
how does it
you're right.
Inventories.
Yeah, inventories.
Everything is interlinked, I guess.
So material cost, how would we calculate? Because it is easy to say I purchased a raw material, but what about the overheads which are incurred while bringing them right up to the stage of location where they are to be stored, all right, the factory. Now those overheads need a consideration, and inventory cost of bringing it to present location and condition is one part where we don't consider refundable taxes, abnormal costs, and also I'll give you a very humorous example which I came across today. A young man was buying a car in Mumbai, and then he said that he will get the car from Pune, which will be more tax effective. Not income tax effective, I'm talking tax effective, you know what I mean. So when the car was coming, he knew that his driver is going to give a lift to some of the people and make some money out of it. He being a pakka businessman, he told the driver itself that you ensure that they give a lift to some 3-4 people to come from Pune to Mumbai and earn some 200-300 rupees. If you earn 400 rupees, I'll give you 100 out of that. And as expected, he earned that 100 rupees and gave 300 rupees to the owner. And the owner, as an IFRS consultant, was asking me, can I capitalize the car value minus the 300 rupees which are received as income? But that's an abnormal income. And in the Ind AS and IFRS standard, it has been mentioned clearly. And I'm sure the CAS Pandits also will take care of that. So the material costs have to be recorded in that fashion. Now we talked about raw material, but what about WIP and finished goods? We have similar challenges where the overhead allocation, the overhead absorption, and the rightness of the employee cost is calculated while valuing the inventory.
We can also talk about CAS 7, employee cost, the most dreaded topic of IFRS, ESOP, and defined benefits.
Dreaded topic of IFRS, Purda, but you conquer them with the world-beating marks. The defined benefits, that is actuarial gains and losses, and considering them in case of employee cost correction, but the actual gain and losses are going into other comprehensive income since they are externally driven. On the other hand, employee stock options, and for that matter, even non-employee stock options, when those costs are registered in the form of employee cost or goods and services, but for the employee cost, it will be, for the employee stock options, it will go into the employee cost, and there are a lot of valuation issues involved. So CAS and IFRS, when it is being linked or reconciled, the challenging areas of ESOP cost and actuarial valuation and defined benefits needs a consideration. So while I'm midway through telling these complications, a cost accountant, I'm sure many of them who are sitting and watching must be standing up in the chair and guessing that as it is, they have acquired a huge knowledge by a big CMA degree, which is tough to pass. I lost many of my hairs in that also. Now they have to champion IFRS and Ind AS also because they have to do CAS. And they have to do anyway IFRS Ind AS for their jam, because bread butter they are getting from cost accounts anyway. Yeah. What's next?
The next is we jump to CAS 12, repairs and maintenance.
Now that is, one knows that in the fixed cost or PP or tangible asset standard of IFRS and Ind AS, we are talking about capitalization of all the replacement components. For example, if I replace, jokingly saying, if you keep aside the mortality aspect, a tire replaced will have to be capitalized. And whichever implementations we are doing, we are finding that the majority of the repair maintenance expenditure is getting capitalized in a Hindi language. Somebody is telling me to talk in Hindi. In the Hindi language, it is called as routine ghaspus. Roj ki ghaspus is the only one which will come into the repair standard, repair expenses. And I hope repair translation matlab durusti. Please correct me if I'm wrong. So when we calculate the cost of repairs and maintenance, tomorrow when a cost accountant comes across that the repair maintenance account, the ledger account itself has gone to near zero because it considers only routine ghaspus, and all the replacement costs, for example, inspection cost, for example, overhauling cost, for example, machine part replacement parts, and even the labor charges for that, all that are going to be capitalized with the assets. And that understanding has come into the cost accountants level, because last month I had an opportunity to talk in the Navi Mumbai chapter, and when we asked how many of the cost accountants are ready for IFRS, 70% of the hands went up, and I'm proud to say that. So I'm sure all these cost accountants are aware that the Class 12 repair and maintenance, they will have to watch out how much of that is getting capitalized coming in their standards, because 15, 16 accounts as a previous year for some of the companies above 500 crores are already getting finalized.
Yeah. Then coming to Class 13, service cost centers.
Yes.
In case of joint sales, I guess it affects.
Service cost centers, yes. I mean, my paid company, one time where I worked, Blue Star, who was selling air conditioners along with free maintenance for 5 years. But come Ind AS, there is nothing free in the world. So if somebody sells at a value an air conditioner including 5 years maintenance free or lifetime free, then one will have to fair value both the sales prices, the revenues. So air conditioner separately and service revenue to be booked separately. Service revenue will be a period income. Now, how will you draw the period income unless we know what is the service cost? So once the service cost is decided, as a paramount margin-based business, I mean, I remember we used to make very good margins there. I won't tell you the percentage in Blue Star, but yes, most of the companies are making big money under services also. Now those services, therefore, revenue to be booked, which will be a cost plus method or markup over cost method or a margin percentage method. So the cost accountant will have to consider the margins in the service cost in order to arrive at the service revenue portion at a fair value as stated in the standards of revenue recognition, which considers not only the revenue recognition, IFRS 15 and Ind AS 115 I'm talking about, but apart from revenue recognition, it looks across also the cost of fulfillment. And the cost of fulfillment of services, nobody better than a service cost calculation. Who does that? A cost accountant, and he has to follow CAS. So the CAS and IFRS and Ind AS will have to talk face to face and reach and I would say tally, if not reconcile.
Then coming to CAS 14, which talks about pollution control costs.
Right. CAS 14 are the pollution control costs. I mean, I remember my another paid company where I worked. Sorry to say, I worked in 7 companies like this younger generation who changes the jobs, but they change countries also. I changed countries, but not that much. All right. So we are talking about the pollution control. Navin Fluorine International, which produces the CFC gases, always have an impact of the chemicals in that area, and therefore we used to buy pollution control equipments. So what is that we used to do? Calculate on one hand what are the compensations required to be given for the pollution cost, compared with when we will buy the pollution control equipment, government will give the grant, and that government grant, whatever is the benefit, vis-a-vis that the compensation amount saved, a strategic level comparison used to be done every year, and this was being done not other than anybody but I remember you that 82 years young man Manu Bhai Desai, current chairman of Surat Cost Accountants Chapter, he is in the audience right now, and I remember how we worked upon those principles when I was in that my paid city called Surat in Navin Fluorine Industries. And the pollution control cost on one side and the government grant giving the subsidy towards buying of pollution control equipments. So it was a saving of compensation cost or getting of a subsidy. There used to be a trade-off, and for that trade-off, nobody but I will hold cost and management accountant to be squarely responsible.
We're done with the CAS, I guess. We got a brief on how different, how IFRS helps cost accountants.